Okay. Chapter 24, Part 2. It doesn't want to move. So we've just finished going through the advantages and disadvantages of decentralized operations. We talked about centralized versus decentralized companies. And then we looked at some responsibility reports for a cost center and then responsibility reports for a profit center. Now we're going to look at an investment center. All right, and this is like a company that has control over the revenue, expenses, and also the balance sheet for the company. Okay, so also the assets. And they'll also talk a little bit about a balanced scorecard, which is too bad we don't have more time to spend on this because it's a really important concept. So, moves out a little bit. An investment center manager has responsibility and authority to make decisions that affect cost, revenues, and assets. Okay, so cost and revenues, and also assets. All right, so he's got a piece of the balance sheet, how much is invested, and that makes a big difference. These managers are often used in diversified companies by division. Okay, so think of a division of General Motors, for example, maybe a particular model of a car, maybe the one that's in charge of doing electric vehicles. Okay, in such cases, the divisional manager has authority similar to that of a chief operating officer or the president of a company. I mean, for all intents and purposes, they look like separate companies. Because these managers have responsibility for revenues and expenses, income from operations is part of investment center reporting. And also, because he's got responsibility for assets, we use a couple different measures to evaluate the performance, including a rate of return on the investment. In other words, we're going to add up all of the assets they have, and we're going to take our income, for example, and divide it by total assets. So if we can say for how much money they have invested, how are they doing? Okay, and also another concept called residual income. So here is a divisional income statement for this company called DataLink. And they've got a northern, central, and a southern division. And here we've got revenue and operating expenses, income from operations before service department charges. We've got some service department charges, and here's their income. Okay, so it looks like from this that the central division is making the most money out of everybody. And because investment center managers control these assets, they've got to be evaluated on the assets also. And one of the measures that we use is called return on investment. And whenever you see the words return on is income, like net income. Okay, so return on investment. So this would be income from operations, that's our return on, divided by invested assets. And just so you know, these invested assets can be computed in many different ways. It could be like if you were a bank, you would take a rolling average for a month. Okay, maybe in there, and that would include every day's average. Or you might take, in the textbook, you might take the beginning of the year and the end of the year and divide it by 2. All right, just a real simple average. So ROI is what we call it, is useful because it involves all 3 factors that the manager is responsible for. And the higher the return, the better the division is using its assets to generate income. So in effect, ROI measures the income or return on each dollar invested. Okay, so as a result, like if you had, let's say you had a small business yourself and you invested $10,000 on it, and after the first year you earned $2,000 on it. Okay, then you earned $2,000 divided by 10,000 or 20%. You earned 20% on your investment. Okay, so that's what the return on investment does. It measures the income or return on each dollar investment. So it's a good way to compare one division to another one. So here are the invested assets for these three divisions, okay? And remember, we thought the Central Division was the one that was making the most money. So we've got Northern 350, Central 700, and Southern Division was 500,000 in assets. Now here's our return on investment. See, it tells a whole nother story. We have the Northern Division has 70,000 in income, divided by 350,000 in assets, a 20% return. Central Division had 84,000 in income, but it had 700,000 in invested assets. Okay, so that's a 12% return. It's much lower. And the Southern Division had 75,000 in income, divided by 500,000 in assets, it's a 15% return. Okay, so and think about return on investment. So it's return on investment. Okay, the return on is on the top. That's your income divided by assets. It's really easy to transpose this stuff. So sometimes you need some tricks. And to analyze the differences, we go through the DuPont formula. And this has been in use, since DuPont was alive. And he viewed the return on investment as the product of two factors: profit margin, which is income to sales, and also investment turnover, which is the ratio of sales to invested assets. Okay, so let's see what happens. Here are the formulas for this. Return on investment is your profit margin times investment turnover. Okay, and that's what we're calling a profit margin. Think of it as operating income, okay? But the return on investment is income from operations divided by sales. This is the DuPont formula here. And then sales divided by invested assets. So if the sales cancel each other out, you're left with income from operations divided by invested assets. Okay? So this formula is useful in evaluating decisions because the profit margin and investment turnover reflect these relationships. First of all, profit margin indicates operating profitability by computing the rate of profit for each sales dollar. And as the profit margin increases, all other factors remain the same, the division's rate of return on investment will increase. And then investment turnover indicates the operating efficiency by computing the number of sales dollars for each dollar of invested assets. Okay, so you can read about this in your textbook and think about it and follow it there. Okay, now here is the DuPont formula. It's going to give you the exact same results that we had at ROI. We had 20%, 12%, and 15%. But instead it just takes it apart into these two pieces. Okay? And each one individually is worthwhile to look at and evaluate because it gives you a slightly different perspective on the company. So to increase the return on investment, you can increase the profit margin. Okay? Or you could look at the investment turnover, see where your weaknesses are, see how it compares to the prior year. So let's assume that the revenues of the Northern Division could be increased by $56,000 through increasing advertising to $385,000. Okay, so how much was advertising before? Seems like we want to know that, but we're increasing advertising. The division's income would increase from $70,000 to $77,000. So our revenues would go up. And operating expenses would follow to some degree. Income from operations before service department charges, our income from operations are 77%. So now the return on investment for the Northern Division is 22%. What did we have up here before? Northern Division before had 20%. So this has increased it to 22%. Okay? And it's also useful in deciding where to invest additional assets. Should they give priority to expanding operations in the Northern Division because it earns the highest return on investment? The Northern Division right now is earning 20 cents on each dollar invested. Okay, in contrast, Central and Southern only earn 12% and 15%. Okay, so is that where we should necessarily put our money? You got to be a little bit careful there. One of the disadvantages of ROI is that it may lead divisional managers to reject new investments that could be profitable for the company as a whole. For example, let's say that the Northern Division is earning 22% now. Well, if the Southern Division has a project that would be good for them that would earn 20%, okay, or let's say the Northern Division had a project that would earn 20%, they would reject it because it's not as it would bring down their 22%. Do you understand that? Okay. Whereas the Southern Division, I think, was earning 15%. If they had something that was earning 17%, they'd be thrilled, and they would go for the project. Okay. Whereas the Northern Divisions would say, no, it's not good enough for me, but it would be good for the company as a whole. So that's what they mean here. Okay. So this is where we left off, right? Yeah. Assume the following returns. So we've got 20% is for the Northern Division. 20% is our current return. The minimum acceptable by top management is 10%, and the expected return, what they want, is 14%. Okay. So if the Northern Division, he has this other project, he's going to reject a project even though it meets the 14% criteria and the 10% criteria because it's lower than his 20%. Okay, so we've got to do things to make sure that doesn't happen. And here's an example. Campbell Company has income from operations of 35, invested assets of 140, sales of 437. So use the DuPont formula and show the profit margin. Profit margin is 35,000 divided by 437.5. Correct? Just moving this over. Investment turnover is sales, 437.5 divided by assets. So how many times does our assets go into the sales number? 3.125. Now this standing on its own doesn't mean anything until you can compare it to a similar company or to say this company last year. And finally, return on investment. And the return on investment is our profit margin, 8%, which is income from operations divided by invested assets times the investment turnover. Okay, so you have to look at those formulas and see how that works out. Actually, we'll do one here together. Now, residual income is the last measure that we'll use here, and I think it's a good measure. I think it's a good thing. It's useful in overcoming some of the disadvantages of the return on investment. And residual income is the excess of income from operations over minimum acceptable income from operations, okay? So what we do is, let's say that you have $1 million invested in assets, and top management says you have to earn 14% on that. Okay, so that's the minimum return set by top management. Okay, and that's based on factors like the cost of financing. It's in the market. That's what their investors expect. So that's what you have to have. Now, the residual income is the excess over that. Okay, whatever's above what's expected. So here we've got a company where this is our formula. Income from operations less the minimum acceptable income from operations, like a percent of invested assets. Now pay attention to this one part right here. You have a hard time getting this piece right here in your head. So you're going to take your assets and multiply it times the minimum acceptable return. Okay? And the difference between those two is residual income. Income from operations minus the invested assets times the minimum acceptable return. That residual income is the excess. And here's an example of residual income from these three divisions. Here's our income from operations, and these are their invested assets. And what the company wanted was a minimum acceptable income of 10% on invested assets. So that would be 10% of 350 or 35,000, 10% of 700,000, 10% of 500,000. Okay? So the residual income then is 35,000, 14, and 25. Okay, so we're looking at a whole number here, not really comparable at this point. So what's good about it is that it considers both the minimum acceptable return, it factors in invested assets, and it also looks at income from operations for each division. So it encourages division managers to maximize income from operations in excess of the minimum. Okay? So it's an incentive to accept any project that's just above that minimum return. So it dampens the effect of that, not wanting to take anything under what you've got. You understand? So here's our Northern Division again. Their current return on investment is 20%. The minimum acceptable was 10, and the expected return on investment for new projects was 14%. So if the manager is evaluated on new projects using only return on investment, he would reject a project because it would decrease the current return of 20%. Okay? So it might help the division, but it hurts the company as a whole, right? But if you're evaluating that manager based on residual income, then the new project would probably be accepted because it would increase the residual income. Okay, it would increase that, it would be over that 10% on invested assets. Okay, so what's good about that then is that residual income supports both divisional and overall company objectives. So this is the kind of stuff you need to know for multiple choice questions. All right, so make sure that this is clear. If you've got any questions, don't hesitate to ask. All right, so here's another little tiny chart here. This is the wholesale division of Peanut Company. His income from operations of $87,000. I don't know if you can see that. $87,000. Assets of $240, and the minimum acceptable return on assets is 12%. So we're going to take $240 times 12%, and that gives us $28,800. The residual income is $58,200. Okay. Now just a little bit here on the balance scorecard, and this is a way to another performance measure for a company that gets away from financial performance and looks at other dimensions of a company. And if you wanted to Google this and take a look at balance scorecard, you'll be amazed. There's a whole world out there about this. Okay, so we might look at things like customer service. Okay, the trouble with financial measures is that they're really postmortems. It's after the fact. Okay, if you want to know if your company's going to be in trouble, then you want to know how many complaints you're getting. Okay, or how happy customers are with products. All right, more of the soft information. So customer service, innovation and learning. Learning affects employees. If they're not learning anything, they're going to walk. And hiring people is very expensive. And then also internal processes. Okay, so this is one cut at it. There are many different balance scorecards out there, and depending on the business, they might look at some different dimensions, and it might even change from say 5 years you do one thing, another 5 years you start looking at something else just because the market changed. So all these things relate to each other. Okay, that's the idea. And the balance scorecard attempts to identify underlying, that's really important, non-financial drivers or causes of financial performance. Okay? So in this way, if you're paying attention to these other factors, then the financial performance could improve. Okay? We can't always just cut costs or increase sales. Nothing's that simple. So here are some of the balanced scorecard performance measures. Boy, I would like you to really look at these and get this in your head. Sometimes they're difficult to see in a question, in a multiple choice question, so we'll really have to practice this. But innovation and learning is new products, new patents, cross-trained employees, training hours, the number of ethics violations, employee turnover. Okay, these are all related to innovation and learning. Customer service measures, number of repeat customers, customer brand recognition. So you literally get a clipboard and stand in a parking lot and say, have you ever heard of this? Okay. Delivery time to customers, it's really important. Customer satisfaction ratings, the number of sales returns, customer complaints. Okay. I think the hardest one sometimes is internal processes. Sometimes they can ask one that kind of sounds like customer service, okay? But waste and scrap, time to manufacture, defects, rejected sales orders. See, to me, this is where, is it this number of sales returns or rejected sales orders? This is where I can get confused. So I'll try not to ask you any of those, all right? Number of stockouts, labor utilization. And the financial ones are all normal ones, okay, ones that we're used to. Sales, income from operations, return on investment, profit margin, investment turnover, residual income, and actual versus budgeted or standard costs. Okay? It's a whole nother world, isn't it? Okay, we've got just one more.